A super important question to ask yourself before you go out and look at houses is how much house you can afford. And this is a super important question because it could either make you feel super comfortable in your home or it could make you super worried about your home payment. So in this video, we'll be going over how to determine what your debt to income ratio is, which will then determine how much house you can afford. And then we'll be talking about what the maximum loan amount a bank will lend you based on your income and your expenses. And then we'll be talking about the conservative maximum, or what the Dave Ramsey approach would recommend. And then we'll be talking at the end of what the most common and what most financial advisors recommend for homeowners. All right, so before we go any further, we must first consider your specific budget and your specific goals. So what we will be going over are basics and rules of thumb. How much you can afford should be determined by you and really no one else. Often banks will lend you more than what most people are comfortable with. So if you have a lender or a realtor or anyone else, do not let anybody else other than yourself determine what your housing budget is. Peace of mind is better than sleepless nights. So your housing budget should be determined only by those ultimately responsible for the loan. All right, let's get started. So step one is to determine your gross monthly income. And the easiest way to determine this is to use you and your spouse's yearly income and divide that by 12 for each month. So if your income is fixed month to month, you might be able to determine this using a pay stub. So in example number one, we'll be using an income of $50,000 for income number one, and income number two of $55,000. And if you add 50 plus 55,000, that gives us a total of 105,000 gross yearly income. And if you divide that by 12 months, that gives us $8,750 gross monthly income. In example number two, we have a yearly income of $50,000 plus a yearly alimony of $20,000, and if you add 50 plus 20, that gives us a total of $70,000. And if you divide that by 12 months, that gives us $5,833 of gross monthly income. Now, keep in mind, you must document every type of income you use to qualify for a loan. So other streams of income besides W-2 or earned income that will qualify you or help you qualify for a mortgage include alimony, investment incomes, disability payments, and even Social Security and pensions. All right, so step number two is to calculate our debt to income ratio. Since we've already figured out our monthly income in step one, finding out the debt to income ratio is a breeze. The only thing we will need to figure out is our monthly obligations or expenses. So the debt to income ratio compares your monthly income to your monthly debt obligations. So people with higher DTI ratios have a harder time finding loans, and you will also likely pay a higher interest rate because you're going to be a higher liability. So to calculate your debt to income ratio, first you must add up all your monthly obligations, including monthly rent, child support or alimony, student loans, car payments, monthly credit card minimum payments, and any other debts that you might have. How to calculate a debt to income ratio. So the sum of all your monthly debt obligations divided by your gross monthly income will determine your debt to income ratio. In example number one, we have a rent payment of $1,500, a credit card minimum payment of $160, a student loan of $240, and a car payment of $300. So if we add all those payments up, that gives us a total monthly obligation of $2,200 a month. And if you divide that by a gross monthly income from step number one of $8,750, that gives us a 25% debt to income ratio. So now that you've figured out what your debt to income ratio is, that is pretty much it. This is how you figure out how much house the bank will lend you. Most lenders will not really consider you with a debt to income above 43%. However, there are some exceptions based on the strength of the borrower, the loan, and the type and the lender. Here are some maximum limits DTI based on loan type. So For conventional loans, you're looking at 45 to 50% debt to income. FHA, you can actually go way higher than that at 50 to 57 debt to income ratios. USDA at 41 to 46. A VA loan of 41 to 60 debt to income, and a jumbo loan at the most conservative at 41 to 43 debt to income ratio. If you purchase too much house, you will be what they call house poor, and you won't own your house will own you. So if the monthly mortgage payment is too tight, it won't feel like home. It will just feel like a house with a huge payment. Very few people have impacted everyday Americans and the financial industry like Dave Ramsey. Dave Ramsey's show has played for almost 30 years, so when it comes to financials and conservative finances, Dave Ramsey is the king. And so I figured I would go over Dave Ramsey's guide on home mortgages. So here is Dave Ramsey's way for home mortgages, and here are his guidelines for an extremely conservative approach. A fixed rate conventional income, which isn't really conservative, it's pretty much what everybody recommends. A 15-year term, and this is super conservative because it cuts your time in half, but it also increases your monthly payment. And the last is to make a monthly payment that is no more than 20% of your monthly take-home pay. Now, the fact that he's figuring out what your mortgage payment is after taxes is actually pretty important, right? Because gross is just a number. They still need to tax you, and it's not really what you take home. So you should factor in how much net you have to play with at the end. So this is pretty much a good idea. The only thing is I think that 25% is a little aggressive, and obviously the 15-year for the times that we're living in and how expensive real estate is, it's pretty much impossible. And I'm going to give you an example here. So let's take an example. If we had an income of $75,000, and if you earn $75,000, your tax bracket is 22%, which gets your net yearly income at $58,500. And if you divide that by 12, that gives you $4,875 of net monthly income. And if you multiply that by 0.25, that gives you $1,218 for a mortgage payment. And if you're ready to spend $1,200 on housing, you're looking at a home of anywhere from $100,000 to $150,000 in the Chicagoland area. And if you haven't seen the market, that's pretty much not going to get you anything right now. Now, I know the Dave Ramsey way is a little bit too extreme for most people. So with an extremely high cost of living in housing, most find it almost impossible to afford a home with Dave's guidelines. So let's talk about the most common way that people purchase houses and the most common debt to income ratios. Okay, so what is the most common debt to income ratio? So most financial advisors agree that homeowners should not spend more than 20% of their gross monthly income on housing and no more than 36% on debt. This is often referred to as a 28-36% rule. The 28-36 rule is often the best indicator of home affordability and peaceful nights. So I would consider this rule the most common rule and pretty much the best bird's eye to see if you're able to afford a home. So here's an example of the 28-36 rule if your yearly income is $75,000. So if your income is $75,000, you divide that by 12, that gives you $6,250. And if you multiply that by 0.28 for 28%, that gives you a maximum monthly mortgage payment of $1,750. And that's a little bit more in line where you can actually buy a house. Now, this is the most aggressive. Most people recommend you have a monthly mortgage payment less than $1,750. So if you have a higher than 43% debt to income ratio and are in need of a loan, there are some things you might want to consider to try to improve your chances of getting a home loan. So the simple and straightforward ones are to consider your budget, try to minimize your expenses as best as you can, get a second opinion on your expenses and the loan program that you have, try to increase your income, and get a cosigner. If you get a cosigner, your debt to income ratios might change a little bit and you might be able to get that loan. However, if none of these things are an option, here are some others that might require a little bit of work. One is to consider another loan program. Although conventional loans have the best rates, you might want to consider using an FHA or a VA loan for a more forgiving debt to income ratios. Another thing you might be able to do is to pay down your rates. So if you have some cash in reserves, you could always invest it into your home by lowering your rate and then lowering your monthly payment by having a lower rate. The last thing you can possibly do is to restructure debt. So sometimes you're able to refinance and pay off some of the loans in order to lower your debt to income ratio. So if you have the ability to pay some loans off, first, I would consider talking to a lender for guidance. I hope this video was of some help, and if you have any questions regarding debt to income ratio or how much house you can afford, please comment below. Thanks for watching.